So, Amazon's stock. It's been on a bit of a wild ride, right? The big question is this a warning sign or maybe a buying opportunity? Well, today we're going to use the tools of technical analysis to look past all the noise and the headlines. We're going to decode the story the charts themselves are telling us. So let's dive right in.
Yeah, this is the question, isn't it? I mean, we're talking about Amazon, a true titan of industry, but its stock has been sliding. So what's the deal? Is this just a little bump in the road, or are we looking at the start of something, well, bigger? To get a real sense of it, we've got to dig into the data, and we'll be doing that through the lens of technical analysis.
Okay, so to get to the bottom of this, here's our game plan. We're going to follow the evidence step by step. We'll start with Amazon's recent stock story, what's been happening. Then we'll decode that downward trend. From there, we'll try to gauge the market's mood and figure out the key price floors and ceilings. After that, we'll look at 3 potential scenarios that could play out. And finally, we'll wrap it all up with the analyst's final take.
All right, first things first. Let's set the scene. Because, to have any idea where a stock might be heading, you've got to know where it's been.
So, the last 3 months for Amazon, a bit of a roller coaster, to say the least. Back in July, things were kind of stable, around 225. Then August hit, and we saw some real volatility, even a peak up near 236. But after that, a gradual decline started in September, and that weakness just kept going through October, testing some really key low points. And that brings us right to where we are now.
Okay, so we see this downward path, but how do we actually make sense of it? Well, one of the first tools an analyst pulls out of their toolbox is something designed to see the bigger picture, and that tool is called moving averages. The whole idea behind moving averages is pretty simple, actually. It's all about not getting tripped up by the crazy day-to-day price swings. What it does is it smooths everything out, giving you this much cleaner picture of the stock's real momentum. It's kind of like it helps you see the signal through all the static. Okay, and this is where the plot really thickens. If you look at the short term, the 5-day and 20-day averages, they're sitting above the current stock price. That's a classic bearish signal. But then you look at the long term, the big 200-day average, and it's actually below the price. That suggests there might be a long-term floor, like a safety net. So what we have here is this really fascinating tug of war between that short-term downward pull and the long-term potential support.
So we know the trend, but that's only half the story. We also need to understand the force behind these moves. I mean, who's really in the driver's seat here, the buyers or the sellers? It's time to gauge the market's mood.
And to do that, we use what are called momentum indicators. The best way to think about these is like the speedometer in your car. They don't just tell you which direction you're going. They tell you how fast you're going and how much power the engine, which in this case is the buyers or the sellers, is actually putting out.
So when we look at our dashboard here, it's flashing some pretty clear signals. The RSI is leaning bearish, the MACD is showing negative momentum, no surprise there. But here's the kicker. The CCI is getting down near what analysts call oversold territory. And that's a super important clue. It suggests that the sellers might just be running out of steam, and that could mean a bounce is on the horizon.
And just to be thorough, other indicators that are specifically designed to track trends, things like a rune and parabolic SAR, they're basically saying the same thing. The consensus is pretty strong. Right now, the trend is definitely downward.
So, you take all this data, the downward trend, the strong momentum, but also that hint of exhaustion, and it's all pointing towards a major showdown. This brings us to one of the most critical concepts in technical analysis, the battlegrounds of support and resistance.
Think of it like this. Support is a floor that the price has a really hard time falling through. It's a level where buyers tend to show up and say, nope, not going any lower. Resistance, on the other hand, is the ceiling. It's where sellers usually step in and stop the price from going higher. These floors and ceilings are the key battlegrounds where the fight between buyers and sellers gets decided.
And for Amazon, analysts have drawn these battle lines very specifically. We've got a couple of ceilings or resistance levels up at 222.41 and 224.40. Then, below the current price, there are a few floors or support levels at 217.89, 215.05, and then down at 214.29. And look at where the price is right now, 219.51. It is literally sandwiched right between that first floor and the first ceiling. It's poised right on the edge. Whatever happens next is going to be a really big deal.
So, the million-dollar question, where do we go from here? Well, based on everything we've looked at, the analysis points to three main possibilities. Okay, scenario one, the bullish case. This is the optimistic view. The idea here is that the price comes down to that support floor around 217.89, and buyers, seeing those oversold signals we talked about, step in and think, hey, this is a good deal. If enough of them jump in, they could push the price right back up towards that resistance ceiling, maybe even up to 225.
Then you've got the opposite, the bearish scenario, the pessimistic take. In this version, the selling pressure is just too much. That floor at 217.89 doesn't hold, it breaks. If that happens, you could see a pretty quick drop down to the next support level at 214.29, or hey, maybe even lower, down toward 210 if the selling really picks up.
And then there's the third option, the neutral scenario. Basically, a stalemate. Neither the buyers nor the sellers can get the upper hand. The price just gets trapped, bouncing around between that floor and that ceiling, consolidating and kind of building up energy before it finally makes its next big move, one way or the other.
Okay, so we've looked at the trend, we've gauged the mood, we've mapped out the scenarios. What's the analyst's final take? What does all of this actually mean? Let's bring it all home.
So here's the bottom line. The short-term trend is definitely bearish, no question. But, and this is a big but, there are signs that things might be getting oversold. The stock is right now testing a super important support level, exactly where you might expect buyers to show up. So the key is this. A move above 222.41 would be a really positive sign. On the flip side, a break below 214.29 would tell us there's probably more weakness to come.
And really, this quote just nails it. Technical analysis isn't about having a crystal ball that predicts the future with 100% certainty. It's about understanding the probabilities. It's about mapping the battlefield so you know where the key fights are likely to happen.
Which kind of leaves us with one last big thought, right? Is all of this technical analysis, is it more of a science with all its numbers and charts? Or is it really more of an art, the art of interpreting human behavior in the market? Something to chew on. That's all we've got for this explainer. Thanks for diving in with us.